All right, guys, welcome to another week ahead. I trust everybody had a good weekend. Let's jump straight into it because we've got quite a few things that we need to cover. The first one, unfortunately, the thing that's been on everybody's lips over the weekend has been the Moody's downgrade that we had for the United States, basically taking the rating from AAA down to AA1. Now, I have seen so many incredibly bad takes about this over the weekend. Everybody, using the 2011 S&P downgrade as an example and the Fitch one that we had in 2023 as an example. Look, between those two, the closest one that we can relate to with this Moody's one was the Fitch one that we had in 2023. And that one was mainly on the back of the continued pushback that we had with the threats of government shutdowns in the midst of the the debt worries that we had back then. That one was a little bit more impactful for that reason. Right now, though, this is such old news, really. Moody's basically just confirmed what everybody has already known for the last, last 10 years. Is the debt unsustainable? Yes, it is, right? Does that suddenly change everything overnight just because Moody's have now gone from AAA down to AA1? Not really. This should not be a big deal for the market at all. It's interesting because over the weekend I've read so many reports, people saying, oh, but remember back in 2011 when S&P downgraded. Listen, this is so far removed from what happened back in 2011. In 2011, there was a real legitimate European debt crisis, a massive one, right? There was concerns about huge countries not being able to meet their debt obligations. Markets was in a tailspin. It mattered back then. Yes, it mattered back then. Does this one matter right now? It probably doesn't. I mean, also keep in mind that we are talking about a ratings agency that had Lehman Brothers rated as investment grade 3 days before they filed for bankruptcy, right? So let's not jump to conclusions here. I've had so many questions from this over the weekend. How am I going to position for it? How am I going to trade it? I'm not going to trade this. I'm not going to position for it at all because I just don't think it's going to matter to the markets. It shouldn't matter to the markets. I mean, take a look at what happened to yields on Friday, right? There was a couple of participants that really pulled a fast one on some market participants unknowingly because they said, look at what happened to the bond market, because they showed this small blip to the upside, 6 basis point, 5 basis point move in US 10-year yield, saying, oh, watch bonds at the open on Monday. There's going to be, blood in the streets. Well, this shows you what type of reaction it got. It's just, anyway, the bottom line is I don't want to spend too much time on this. Do I think the Moody's thing matters? Not at all. It shouldn't be something that matters for the markets, especially not coming from a place like Moody's. So just, take this one with a huge pinch of salt. And everybody that tells you expect the end of the world, be careful of stuff like that. I just don't think that's, an accurate way of looking at stuff like this. You have to understand the context. So with that out of the way, let's quickly take a look at the week that was. I mean, equities had another solid push to the upside last week, with both the S&P as well as the NASDAQ breaking and closing back above that 200-day moving average. Also importantly, the New Year's pivot, so your opening range for the new year for both the S&P and the NASDAQ, that's normally a very key input for players like CTAs, like your commodity trading advisors. The fact that we have a close above the 200 as well as the New Year's pivot for both the S&P and the NASDAQ, that's pretty bullish stuff right there. Does that mean the move is just going to continue going up and up and up without having pullbacks? Of course not. But this has been a real positive sign, especially with things like volatility also drifting back down below that 20 level. Shows a lot of ease, a lot of calm in the markets. Does it mean all of the nonsense is out of the way? Does it mean the coast is clear? No, but it's just another thing that shows us that the stock market is not the economy, right? There's other factors in play. And right now, it seems like the bullish momentum is still largely intact, like we saw from the past couple of weeks. Apart from that, in terms of trade updates, the gold short that we got into a couple of days ago went well. Took off remaining positions around that 31.54 level. Now, I had a couple of questions coming in asking what exactly was I looking at when we went into gold shorts. Now, we discussed this already, but just as a quick reference for what we were looking at the time, let me just bring this up. The first thing that we were looking at the time to give us a bias to the downside was, let me just bring this on the screen, was the drop that we had in implied volatility. Remember that volatility ramped up like crazy when we started pushing up into further all-time highs. And take a look at what happened. When we reached that first all-time high, we had a big push to the upside in implied volatility, getting to some pretty expensive levels. Take a look at what happened though with that second push to the upside, this one that we sold into. So that's the first push into all-time highs. That's the second one. On that second push to the upside, we didn't see anything close to the type of volatility scare that we had back with that first push. Volatility was basically rolling over and pushing lower despite price pushing up. That was the first warning sign saying, hey, watch this. This isn't something that should be happening. The other thing that we were watching, of course, at the time was the big divergence that we had between spot prices, as we can see in white, which is that second push to the upside, and ETF holdings. That divergence, given the close correlation we've had with these things, and obviously flow dynamics, keeping that in mind, that was one of the key reasons that we were looking at as well. And obviously positioning was the other one that we were keeping in mind for that push to the downside, where despite price making another attempt at all-time highs, we saw large institutions actually dumping their longs, not because they might have changed their mind about gold, just because they were getting maybe a little bit cautious, maybe taking some profit off the table after what was a very good run. So these was the three main reasons what we were looking at for that gold short, and decided to get out when we got close to that key level of support that we marked up a couple of sessions ago. Now, in terms of oil longs, the only thing that I was looking, got a couple of questions on this as well. The only thing that I was looking at for oil, as we discussed at the time, is really just volatility, guys. Volatility, just like we saw with oil or with gold a couple of seconds ago, volatility was the key driver there. Where with that second push that we had to the downside in price, despite another attempt pushing lower, despite the bad news we had out of Saudi, despite the bad news we had out of US-Saudi relations at the time, it actually saw a huge reduction in implied volatility pushing lower. Now, think about it again, we've discussed this many times, but it's like an inflatable ball that you put underwater, right? If it takes constant pressure for you to keep an inflatable ball under pressure. Think of that as rising implied volatility. You keep the pressure there. There's continued put pressure. The moment that you just release that, you don't have to push the ball up. If you just release your hand, the ball is going to pop out of the water. And in the same way, that's how you can look at things like implied volatility. When you have that continued downward pressure being put on that asset with rising volatility, it puts continued pressure on price. But the moment that that volatility just eases up, when you have implied vols rolling over, it almost has that immediate whipsaw reaction pushing price to the upside. And that is what we were playing for in terms of oil longs. Now, obviously, the Iran news that we had last week did see a little bit of curb in that upside move, but I'm still holding on this one. We have taken some profit a little bit higher on that first initial position. So we'll see what happens to the second one. Apart from that, also obviously got into dollar longs. Now, this one was a lot simpler. The main reason for this is I didn't really see any reason for the push that we had to the downside last week. Yes, inflation came in slightly softer than what the markets had anticipated, but inflation is still way too high for the Fed to even think about aggressively cutting rates. We also have the continued trade optimism, which should be a positive for the US dollar. And again, from a positioning point of view, nothing has really changed. Take a look at how stretched short the markets are right now on the US dollar. So I still like the odds of further upside there for the US dollar. We have taken some profit at the 1-to-1. Rest has been moved to break even. So it's a free trade. We'll see what happens to this one playing out over the course of the week. Now, in terms of the week ahead, we've got a couple of things coming up. In terms of equities, the first thing to keep on the radar is obviously earnings, which continues this week. There's two particular names that we need to watch. The first one will be Home Depot. The other one will be Target. Remember, right now, given the drop that we've seen in consumer sentiment and consumer confidence, the big push we had to the upside in consumer-related inflation expectations, there's going to be a lot of focus on how these names report on earnings, especially with the Walmart things. I'm not sure how many of you have tracked what Trump has said about Walmart, and because of what Walmart said about tariffs and how that's going to impact prices, etc. There will be a lot of focus on any forward guidance, if we get some, from these companies. And just from a pure weightings perspective, as always, a name like Home Depot has 7.5% weighting in the Dow alone. That matters, right? That's a big name. So watch out for things like Home Depot. Watch out for things like Target. That's going to be big names to keep on the radar for equities, given all of the concerns we have about the US consumer right now. Now, apart from that, in terms of the calendar docket for the week, we've got a lot of Fed speak. Unfortunately for us, there's going to be a lot of central bank speak that we need to navigate. I'm not sure how much more information they will be able to give us in a week like this, but obviously given everything that happened last week, given the trade uncertainty, given the data we had, it'll be interesting to watch. It'll be important to watch. Even the Bank of England speakers will be interesting, because we obviously get UK inflation data this week as well, which we'll touch on in a second. Now, in terms of main events, I think the RBA coming up on Tuesday is probably going to be one of the main events for the week that we'll need to watch, because I think we are in a very interesting situation right now. If you take a look at where rate pricing is sitting for the RBA, you can see that the markets have already fully discounted a 25 basis point cut for the bank for this week, right? A cut probability is sitting at 98.6. But I do think that the markets might be underpricing the risk that the bank might hold rates this week. I know that is a very outlandish thing for me to say, because if you ask Reuters, all participants in the Reuters poll expects the bank to cut rates. Almost each and every single investment bank research note that I've read about this says the bank is going to cut. And you know what? They are most likely going to cut rates because the markets are allowing them to. There's also political pressure for them to do that. But this is the RBA. This is a bank that has surprised the markets before. And I do think there's some underappreciated risks that maybe these guys hold rates. Why am I saying that? Well, firstly, the data that we've had running into this meeting, it just wasn't that bad. Right? If you take a look at, let's take a look at some of this data under the hood. Yes, this is what everybody is looking at. This is the inflation data. Is inflation on the quarterly level now back within the bank's 2 to 3% target band? Yes, it is. Are we closer towards the bottom though? No, we're basically sitting flat in the middle in terms of the trimmed mean as well as the monthly weighted average. But the quarterly number just dipped back into or below that 3% level. Now, this is what most participants are hanging on for the reason for the bank to cut rates. Do I think that's enough? I don't think that's enough, because take a look at the other data. GDP actually came in okay, right? GDP came in slightly better than what the markets had anticipated in Q1. Was it a massive, monster beat? No. Was it big enough or good enough for the bank to potentially just give themselves a little bit more time before they cut rates again? I would think so, right? What about employment? Employment came in okay. We had a stellar jobs number coming out last week. And look, it's been very variable. We've seen big down months, big up months when it comes to Aussie jobs. But if you take a look at the average for the year so far, taking January, February, March, and April data together, right? We are looking at an average, 4-month average for regular employment at 24,000 and for full-time employment sitting at 17,000, right? That's hardly bad news if you take a look at what the trend was over the course of the last 2 years now, right? So employment doesn't look that bad. Growth doesn't look that bad. Inflation is lower, but not crazy low. And yet the markets are like super aggressive in terms of their cut expectations for the bank. I think there is a risk that maybe these guys come out with a hold. Also, keep in mind, if you take a look at what they've said recently, a lot of participants are hammering on just the bad news, right? Oh, there's a lot of uncertainty, possible that global uncertainty over US tariffs have significant impact. Global risk to growth has increased, tilted to the downside, right? It's such bad news. But remember that a lot of these things that the bank have feared, a lot of those stresses have eased over the course of the last few weeks now, right? The good news that we had between the US and China last week, surely that can give them reason just to be a little bit more patient. Also keep in mind, they say clearly that it's important to safeguard their progress on inflation and not to ease policy prematurely. Now, again, is this enough for them to not cut rates? Probably not. But do I think there's a 0% chance of them holding rates? No, I think the odds of a hold is closer towards like 30-40%. And I think that can create some opportunities, because if everybody is expecting the bank to cut rates, if they end up not cutting rates and they're holding rates steady, that's obviously going to create a lot of short-term upside potential to trade the Aussie dollar higher. My preference to trade that in a week like this would probably be something like the Aussie Swiss franc. We've had a very good recovery recently, pushing right into that key level of prior support, now resistance around that 2024 August lows, around that 53 level. I do like some downside potential for the Swiss franc still. We're at a pretty decent level here for a possible breakout, retest, continuation. And again, if we get the green light with the bank holding rates, first target for me for that would be 54.50, and potentially back above that would be the 55 psychological level as well. So that's an area or one chart that I am looking at. The other one that can also be considered is something like the Aussie Kiwi. A little bit less excited about this one though, because I do still think there could be some downside pressure for the pair, for the reasons that we've explained previously. Also, what I like about the Aussie Swiss franc is if you take a look at the combined differentials, looking at risk reversals, looking at yield differentials, looking at growth differentials, commodity trade, terms of trade, all of these things do still suggest some upside risk for the Aussie Swiss pair. And obviously, if I get a catalyst like the RBA holding rates, that could be the best case scenario to look for a little bit of upside there in the Aussie dollar. So that, I think, from an economic data point of view, is probably going to be the most attractive thing we have to look at this week. We also have some Canadian CPI data coming up as well. Look, in terms of the CAD is still stretched on the long side versus the US dollar. If you take a look at the percentile chart here, you can see that the CAD is still in stretch long territory against the US dollar. If you take a look at interest rate expectations for the bank, we can see that the markets aren't sure whether we're going to get a cut or not, right? We had 60-40 leaning towards a cut, which means that if we were to get a massive downside surprise in inflation data, then that could lead to the markets fully pricing in a cut, which should lead to a little bit of downside for the CAD, which means that dollar CAD upside could be in play if we get a big enough miss. Potentially looking for a move back up towards that 140.50 could be on the cards. If it's a big enough miss, maybe even higher. But that does look like a bit of a stretch for a quiet week like the one we have planned this week. So just keep that in mind. The other one is UK inflation data. Look, I'm not expecting a lot from this one. The markets are expecting a huge upside move in inflation. You can see here, core month over month expected to go from 0.5 to 1.3. Year over year expected to go from 3.4 to 3.7. Headline year over year expected to go from 2.6 to 3.3. This is all because of the yearly annual services numbers that obviously is going to make its way into the basket. We also have energy subsidies rolling off. There's a lot going on here, which is seeing the markets expecting a big move to the upside. What does that mean? It means that if we were to see a high number, even if it's slightly higher than this one, it shouldn't really surprise the markets that much, because everybody's expecting there to be upside risk. That means if we were to see a huge downside surprise in inflation, that's arguably the more interesting thing to look for a possible trade opportunity. And in that case, I would be looking for some downside opportunity in the likes of the pound dollar, because I do still think there's some upside potential for the dollar in the week ahead. So apart from that, not a lot else to be excited about this week. We obviously have the flash PMI data coming up as well. I don't think these things will matter, because there's been so much back and forth with tariffs, right? Some of this will include bad news that we had between US and China. Some of this will include good news that we had between US and China. The market should be able to discount the flash PMI data really, really easily this week. So I don't think there's a lot of opportunity to be trading that. And apart from that, it's a pretty boring slate for the rest of the week. So key focus points will be the RBA. If we get some type of surprise coming out from them, I think there could be some interesting moves to play out for the Aussie dollar if that's the case. If that doesn't happen, then obviously obviously just the normal running of the mill, watching what happens to those earnings names, watching what happens to the trade situation between the US and China will be important for the week ahead, as always. So with that said, hope everybody will have a fantastic week ahead, and any questions, don't hesitate to let me know.